So today we are going to discuss proper money management in FX. For those of you that are here, can you please confirm that you can hear my voice and also see the screen in front of you clearly? Okay, good. So the agenda is to give you a quick introduction on who we are, and then we're going to discuss price action and mean reversion, which is the two types of markets that you will encounter when you trade. And then we're going to discuss account sizing, how you set your risk levels per trade, and then some currency trading dangers if you're not careful with money management. And then finally, we'll end on a Q&A. Okay, so this is a webinar particularly catered to those that are new to trading, that don't know too much about basic money management concepts. Before I proceed, please take a moment to read this legal disclaimer and also risk warning, which is very important, especially if you're new, and then we'll move ahead in a minute's time. All right. So Blue Sky Forex is part of Blue Sky Binary, an education, research, and trading group. And we basically train traders like you, especially newbies or intermediate traders, to get to the next part of their trading career, become semi-professional to professional traders. We provide 24-hour trade support and analysis to allow traders such as yourself to trade safer. We only work with the best brokers in the industry, and Hot Forex is not only one of the best, but one of the biggest. And we are presenting this webinar on behalf of Hot Forex in order to educate you, to help you become highly profitable currency traders. Now, whether you are trading short-term or long-term, technical or fundamental, whether you're trading a trending market or a ranging market, it's really important to note that all your strategies will not work if you don't have good money management in place. Okay? And good money management also means having realistic goals and targets. These definitely need to be written down so that you have some sort of tracking capability to see how you're doing relative to your expectations. Okay? So there are 5 things we need to look at. Let's start with the first one. This is determining account size for retail traders. And you're a retail trader, you represent around 6 to 8% of the market. The rest of the market is institutional. And so it's very important that when you are entering FX for the first time, there are 2 sides of the coin that you need to pay attention to. And we'll go over these now. So to start with, we see this problem quite often is people come into foreign exchange with real money, trading real money, but they want to deposit a very small amount. And I'm talking $100 or $200. And the way FX works is that you can't make a lot of money if you have just such small micro balances without taking on excessive risk. So Certain brokerages will offer you jumbo leverage, right? 500 to 1, 1000 to 1, which in theory makes it possible for you to make, 30, 50% per day on your account. But it's not sustainable, and the risks that you're taking will blow your account. So the reason behind this is that when you are trading in FX, you are trading to make a living, right? You're not doing this just for fun. So every day you probably want to make, depending on your location, at least $20, $30, if not a few $100s. Okay. And the process of taking a trade, it exhausts you. It takes brain power. You have strategy, you have analysis. And if you are just winning your trades and you're only earning $5 on your wins, right? Let's say you go for 15 pips or 20 pips, nice little scalp, but you've only made $5 or $10. You will notice that this actually will wear you down over time. Okay? And what we've seen is people that come in with very small accounts, they go down this route where in order to compensate for their low dollar wins, they will start to increase their leverage or engage in risky trading practices. And that's just not advised. So small capital balances can result in trades being taken that are too high as a percentage of your total balance. A good amount to start with, therefore, is a few thousand. And again, this is not deposit advice. This is not investment advice at all. We always advise you to stick to demo money first till you really start to make money. But if you're thinking about going live, then always note that if you have realistic income goals per month, a few $100s is just not going to cut it, right? So the range we advise our own academy traders inside the Blue Sky Binary Academy is 5 to 30,000. Now, 30,000 is excessive. And certainly 50,000. Some people deposit those type of amounts. What we've seen is it results in lack of respect for your capital. You tend to take on more egregious, more excessive risk than you should, especially in situations of big losses or tough markets like we're in now. And so this is a fine line between too much and then just going crazy. So realistically, um, sort of in the range of 5,000 is a realistic amount if you are serious about growing your capital over time, right? We've never come across someone who started with $100 to $200 account and grown it to 100K or a million or whatever, right? It's just very, very rare, if not entirely impossible. So once you've determined the correct account size, then we need to look at these 5 factors. These are the risk levels. Okay, there's leverage. That's on your total account. Okay, the leverage is applied holistically on your account, not specifically per trade. And then you have risk reward ratio per trade. Then you have the max percentage exposure to your account per trade. Then you have correlation risk and you have event risk. And if you can be on top of these 5 things, you'll be perfect. You'll be well set to have a sound money management strategy. Let's discuss leverage. So, leverage determines how much funds you can borrow from your broker on any given trade, given your cash balance levels in your broker account. For example, if you have $100,000 in cash in your broker account and you have leverage set to 1 to 1, okay, it's the lowest level of leverage. This means you're not trading with leverage, you're actually not trading on margin, and you won't have a margin call. It's the safest way to trade. If you open a $100,000 position, how many ever lots that is on the US dollar Japanese yen, and the US dollar moves up by 1% against the yen, and let's say you're long, then your gain on your account will be $1,000 or 1% ROI. If, however, you are using higher leverage, 5 to 1, 10 to 1, 21, which are all fine, all these levels are fine, then a 1% rise in the US dollar yen will result in an equivalently higher disproportionate rise in your account, right? So a 1% rise may result in a 5% gain if you're using 5 to 1 leverage. But although this is exciting, it's also worth noting that leverage needs to be treated with care because it works the other way around as well. You could see only a drop of 1% on the US dollar Japanese yen, but you could lose 5% of your account because you're levered up. Now, the best traders use 1 to 1, 5 to 1, 10 to 1, 20 to 1, those type of ranges. 50 to 1, 100 to 1, 400 to 1 is exceedingly risky and it's not recommended. The best hedge funds in the world are using 40 to 1, 50 to 1, that type of level. Okay. The second thing, so first we went over leverage. The second thing is risk reward. Before buying or selling currency lots, it is important to set your risk and reward per trade. What I mean by this is, as you know, in FX, you can win more, you can win a lot in your long or short position. Depends on how many pips you capture or you fail to capture, right? So there's a magnitude component here. You can put all your hands down. I'll answer your questions towards the end. This means that the ideal trader is going to do it in such a way that when they win, they're winning a lot of pips, and when they lose, they're not losing a lot of pips. But that's an ideal scenario. As you know, you never trade naked. You always trade with your take profit and your stop loss in place. You set your take profit normally. This is what you should aim for. Again, it's not realistic when you're new, but as you become better traders, this is the ratio you should aim for is 2 to 1, right? The golden ratio, if you want to call it. So 2 to 1 basically is for every pip that you're wanting to gain, or every 2 pips that you're wanting to gain, you're ready to sacrifice 1 pip as potential stop loss. So if you enter a long trade and you set your take profit at 20 pips above the price, then you'll be setting your stop loss 10 pips below the current price. So that if you lose, you lost 10 pips, but if you gain, you make 20 pips. And the risk reward means that, okay, over time, as long as you are over 50% right, so let's say you're 51% right, this combination, this permutation of risk reward and win rate will result in equity curve growth. Your equity curve will positively yield, it'll go up. If you have a risk reward of zero point 0.5 or zero point 0.3, this is inherently weak because what this is telling you is, okay, you may be making 5 pips, 6 pips, 7 pips, you're going for the easy pips, but you're ready to sacrifice much more. And if the market moves against you, you could lose 30 pips, right? If your stop loss is 30 pips, your take profit is 10 pips, you have a zero point 0.3 risk reward ratio. That's bad. And every time you lose, you have to win 3 times to make up your losses, and that's not a way to trade. Okay. Having said that, 2 to 1 is ideal. That's really, really good. But you can, of course, trade with a 1 to 1 risk reward as well. That's perfectly normal. Professional traders do that. That's fine. Right? Just note that there is an inverse correlation between your win rate and your profit factor and your risk reward. So, for example, if your win rate is low, that's okay, 20, 30%. You're only right 2 or 3 times out of 10. But when you win, you should be winning a lot of pips, right? So that it makes up for the times when you lose pips on losses. Okay, a thing to note about take profit and stop losses is that a lot of trade stations today, MT4, the web trader, and on Forex, they allow you to use dynamic stop loss management or trailing stop loss management. This is definitely advised, so definitely pay heed to it. Go and research it. We can also do a session on it if you would like. Basically, how this works is that once your position is in the money, you can move your stop loss closer and closer to the current price and therefore lock in risk-free gains no matter what happens. It's a good way to de-risk your trades. And so we've gone over leverage, we've gone over risk-reward ratio per trade. Now let's go over max percentage exposure per trade. Now, what I told you previously was your risk reward, your take profit divided by your stop loss, right? What happens when you hit your stop loss? You have a bad day and you hit 3 stop losses in a row. The question then is, how much should that hit your total account equity? If you lose a trade, right, should you lose 30% of your account on that or 40%? No. The rule of thumb is no more than 1% of your account should ever be sacrificed. Okay, so if you hit your stop loss, how many ever pips that is, 100 pips, 200 pips, 10 pips, 1% of your account. Hit, go take a walk, come back after 1 or 2 hours, you can re-engage the market, right? If you want to be more mathematically rigorous about it, there's an equation called the Kelly criterion, the Kelly risk formula. This looks at your historical win rate based on your trading, and you need around 100 trades for this for it to be statistically valid. And it looks at your historical profit factor, which means when you're winning, how much money you're making, versus how much are you losing when you lose. These two components will spew out a percentage, this Kelly percentage, and that can be your percentage allocation per trade. Okay, this is a more mathsy way to do it. It's not necessarily pushed or suggested. It's a good one to look at if you're mathsy. Or you can just use common sense and say, okay, I don't want to lose more than 1 or 2% of my capital per trade, right? Now, of course, if your account is tiny, if you have a $500 account or you have a $200 account, then losing $10 on a trade is not the end of the day, right? It's not the end of the world. But if you have a $10,000 account, losing 5% of your account is a problem. A $500 loss on a $10,000 account is big. And you don't want to experience that on a single day. That's something maybe you can withstand over a week or 2 weeks, right? But generally speaking, per trade, you should not risk more than 1 or 2% of your account. So we've gone over leverage, we've gone over risk reward, we've gone over max exposure. Let's draw this to a close, discussing correlation and event risk. So correlation basically is you entering long and short trades on different currency crosses that have a fundamental link between them. And this is a big problem with newbies. Sometimes they get excited, they see head and shoulders pattern there on the US dollar, Japanese yen, and on the euro US dollar, they see a bearish harami. These are all candlestick patterns. And suddenly they're like entering a long on the US dollar, Japanese yen, and a short on the euro US dollar. Now, the problem is if you enter a long US dollar, Japanese yen, and a short euro US dollar, you're actually short the you're actually long the euro US dollar twice. You have a double exposure on that, on this particular combination. Because the US dollar, Japanese yen, and the short US dollar are somewhat inversely correlated, you therefore bring in correlation into your portfolio. If you are right about the US dollar, you make excess gains, but if you're wrong, you hit a double whammy. You get hit twice as hard, depending on, of course, your lot size allocation to each currency cross. To be simple about it, just don't open more than one position at a time. You can make money in FX just taking 1 or 2 good trades per day. High frequency trading is a recipe for disaster because correlation sets in, you become sloppy, event risk sets in, money management goes out the window. So stop the high frequency trading. Okay. Now, you can Google correlation heat map. Just go to Google and you'll find a great website that has that. It's free. And there you can see the correlation between currency pairs if you are looking to trade correlated. We would advise you not to. It's much simpler to just not do that. But if you want to, if you insist on trading correlated, you can just Google correlation heat map. Okay. As for event risk, now this is equally important. This basically means that you're entering a trade in and around a foreseen event, a macroeconomic event like interest rates or FOMC. Don't do it. Okay? Unless you're specifically trading the breakout, you're trading the news, which we teach here specifically over 3 sessions. It's not the subject of this webinar. We're not advising you to trade news, but what we're saying is, generally speaking, you don't want to be trading through events or going into events. Okay? Now, for those of you that are new, you may have heard of martingaling. Martingaling is a problem. Okay, it's a betting practice. It's a practice coming from the gambling and betting industry, and it's kind of tainted the financial investing industry because it's an easy route. And brokers, generally, scam brokers like it when you martingale because you blow your account quicker, right? You don't want to do that. And what I mean by martingaling is if you're in drawdown, instead of accepting the loss and walking away, you just double up your lot positions. You buy more lots of the same trend, of the same pair in the same direction, hoping that the market will reverse. Unfortunately, the market can stay trending in one direction for years, longer than you can stay solvent. So no matter what, avoid using grid trading or martingale strategies. Okay? So to give you a recap, we went over how to size your account. Pay attention to that. Leverage, risk reward ratio per trade, max percentage exposure, correlation risk, event risk. Okay? Now, a few interesting things before we get to the Q&A. Expert advisors. Okay? I know I've been saying this now for almost 2 years. They are not to be trusted. 99% of them do not work. If you find one that you feel works, put it on a demo, test it for 3 months. Okay? Test it for 3 months. If you see it's working on your demo and it's not kind of spread dependent, what we've seen in our extensive research in EAs, and we've been doing this for a long time, is that the EAs that do work, they don't actually work when you switch to a live account because the broker will start to increase the spreads a little bit and the EA just comes undone. These are the scalping EAs. Okay? So test it out on a demo. These EAs also don't have money management inbuilt. Everything we've discussed today, you need to manage manually. Okay, so that's a big problem. Make sure that you're investing in an EA, if you are, that has money management routines in place so that your capital is protected. Okay? Okay, now there are two things I want to discuss before we go to Q&A, because I can see there are quite a few questions here. Firstly, I want to show you something very interesting. Okay, so what's interesting here is finally, after years of research, we are now ready with our own EAs, which work with hot Forex, by the way. And what you see is something interesting here. Okay, so this is a Melissa, meaning multi-entry logic long-term investment and savings EA. Okay, and there are a few things that you'll see stand out about this. Firstly, it's 5,000 trades over a period of, I would say, almost 13 to 14 years. Okay, about 13 to 14 years. So our testing has gone back to 2004. We're in 2017 now. Okay. The initial deposit was $10,000 and it's now 113,942. The total pips this EA has generated is 130,000 pips over 13 years. So we're looking at about 10,000 pips a year, roughly speaking. Okay. What you'll also notice is that it has a positive profit factor. It's not negative. You'll also notice that it has a win rate of 73%, but it uses absolutely no martingale. Okay, It's not a grid trading system. It's not using martingale. Its drawdown is very low, not 8% or so. You can see the equity curve. And now I'm going to show you the monthly performance. 2004, January, all the way to December, and year after you can see the performance. Yes, it has losing months, as you can see, right? Sometimes it has 2 losing months, but it's not had a single losing year, and you can see the red losing months are sparse. This year, for example, in January, February, March, it's been deeply profitable. It had a slightly negative April. In May, it's flat so far. Okay. Now, this EA is a product of years of engineering. You'll also see how it performs on a weekday, per hour, per month, a year. So it's been really well tested. Okay. This is the type of rigorousness you should demand from other EA manufacturers, right? That are telling you to commit your hard-earned money. This is an EA, for example, that has performed through time. Now, what's very important to note, because we were discussing risk reward, right? If you remember, um, take a look at this. The average win is $90. The average loss is $147. Okay, so it loses more than it wins. But what's very important is that it wins 73%, 72% of the time, right? If it was only winning 50% of the time, then this EA would lose money. But because it's winning a very, very high percentage of the time, it actually grows the account quite robustly over time. Okay? And you will have this is the average, 4 wins in a row. And at times you'll have 1.5 losses in a row. So out of 10 trades, you'll have 3 occasions where there are 2 losses in a row. Out of 10 trades, you will have 6 or 7 occasions where it's actually making consecutive wins. So it's a very sturdy EA. Okay. Now the thing is, 4,962 trades, so it's basically 5,000, over a 13-year period, is roughly 1.5 trade per day. Okay. So you'll notice immediately there's no high frequency volume based crap here, right? A lot of the EAs, they have deals with brokerages. They just create volume on your account. They're not actually making money. And the EA manufacturer is getting paid by the broker just to generate volume. This EA can't do that because it only trades 1 trade a day. Sometimes in 2 or 3 days, there's no trade. Sometimes it'll have 2 trades a day. But on a month, typically it'll have around 20 trades, 20, 25. Okay. So this is a pretty powerful EA. Okay. And so what you have to take into account is that EAs are 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 um, are kind of a double-edged sword, because although this EA looks perfect, it looks very good and something we've engineered, we ourselves would tell you put it on a demo account, right, on your hot Forex and let it run. And if you're happy with the performance, then you can take it to the next level. Okay. So let's get back to the thing. I will now take questions. All right. You can ask questions about anything about the money management. You can ask questions about our academy. As you know, we have a FX Academy where we train people like you. It has a 7-day free trial. We're welcome to see you there. But yes, okay, I see a few questions here. So I see one from Luis Roberto. Can we get a copy of the PDF to see what we should be looking for? Yes, Luis, you can just contact webinars@hotforex.com and they will send you a copy of this. And this has been recorded, by the way, so you can access it as well. Any other questions from anyone? Final call for questions. Okay, Luis is asking, is the Kelly criteria a per trade number or a total risk number? It's a per trade number. Sure. Any other questions? Anyone? Okay. So it goes from Bismarck Quabena. How long will it take to build your account when you lose your $200 account? If your account goes to zero, you can't build it. You just have to redeposit Bismarck. So let's say you have a $300 account and you lose 200. It will probably take you a year to build it back, 6 to 8 months. That's how bad it is to trade with such a small account. Unless you're doing research and you're just testing, you're not actually in it to make money, then it's a different story. Then you can of course trade with such a small account, no problem at all. Okay, so I see no further questions, so we'll all see you next week. All right, take care.